Continuing with our pre-scene now, this is part 2. So up until now, I hope you've covered the industry analysis that we have given you, understood it, registered it in your mind, comfortable with it. Then you moved on to the pre-scene analysis part 1. Hope you've gone through that as well very carefully, understood our method, understood what we are advocating, and understood the detail that we go in. Now we'll continue where we left off, which is start with the explanation of the third director of our organization. We spoke about 2 directors up until now. We're now on the third one. So let me begin. Third is Henry Lopez, who is the recipe development director. So Henry has been with the company from the beginning. He is responsible for developing and testing all recipes and is a fully qualified chef with many years of experience. He is particularly interested in the nutritional value of food. So anything related to recipe development, you can use Henry's name because he has that background. So he's worked with the business from the very beginning. So he has developed a deep understanding of the value of the culture of your organization. So he's better able to deliver what the customers want. As he is a fully qualified chef, he merits the position that he holds, and his recipes have been a hit because it clearly shows in the growing revenues of our company. Next, we have Greta Beats, who is the production director. Now, Greta has been with the company since 2018 and is responsible for ingredient procurement. So she is responsible for all the buying and all the activities at the production facility. She is responsible for 2 important things: buying and production activities. She previously worked as a senior buyer for a supermarket company. So she will know, where to buy, how to exploit good price opportunities. So Greta is a champion of sustainability as well. So important information here, she is very well experienced to carry out her job. Yes. She previously worked with a competitor, so knows the day-to-day of her job and has worked her way up. Competitor, I mean in the sense of a business that also works on strict budgets, strict margins. So she will be able to better make buying decisions because supermarkets also have very strict buying compliances, buying measures. When she comes into our business, that adds value, right? So she's bound to have good market external knowledge, which could be very beneficial for us. Her interest in being even more sustainable can be a big boost and a positive sign for the business. When discussions are being made about production, about supplier relationships, you can use her name and it will add value to your answer for sure. Last, we have Jack Quinn, who is the finance director. Jack became a qualified accountant in 2004 and has been with the company since 2014. Roughly 8 years he's been with the company. He's responsible for all finance and human resource issues. He's dealing again with 2 departments. He has been instrumental in securing finance from private investors and banks and has built good relationships with financiers. So Jack is educated to carry out his job, yes. He will have good connections in the business as he was able to secure financiers. Shows us that if we need further investment in the future, we can rely on him, right? Because he has these relationships, he has these contacts. One interesting aspect to note here is that he's responsible for finance and for HR. These are 2 very important functions in a business. As the business grows, we may need to separate the HR director so that Jack can focus on his core competencies, which is the finance aspect. In many big companies, there is a separate HR department, there is a separate HR director. So as we move on, that is a possibility that Meals at Home also breaks this job. I'm going to make a deep analysis as we move on the director status, the director positioning, and the corporate governance picture as well. But let's get through this, organizational chart information and all of that they've provided us. So after the director information, they've given us sales, distribution, production, and finance team breakdown. You will see over here that the sales and marketing director Ben Jonas is at the top. Then the subscription services senior manager, marketing manager, distribution manager all report into him. So it's kind of a pyramid structure where the managers at the functional levels, at the departmental levels lead decisions, but they report into a final director. The final director makes the most valuable decisions, and this is a very clear evidence of a functional structure. I'll discuss on this as we move on. Same way in the production department as well. Production director leads. Under it, there's the procurement director, warehouse director, production director. All of these, production manager, sorry. All of these report into the production director, who is Greta Beats. Same way is the finance team. For the finance team as well, Jack Quinn is at the top. He's the director. Under him, there is the finance manager and the HR manager, Mina Jaff and Claire Turner. Under the finance manager, there is the finance team. There are 5 assistants and 3 finance officers, out of which you are one. So your role in this case study will be mainly supporting Claire and Jack. So just keep in mind, and this clearly shows us that there is again evidence of a functions structure. So what is a functional structure? You may be thinking, right? Now a functional structure is one where similar activities are grouped together and there is a degree of specialization, which means everything related to finance and HR under the finance and HR director, everything related to production under the production director. They only focus on their role, their specialization. So this is generally recommended for smaller sized organizations who work in a stable environment and do not offer many different kinds of products and services. This is the general criteria. So a very real question here and a thought that comes to my mind is, now Meals at Home is a medium-sized organization, I would say medium to large, isn't small anymore, it's still growing, and the environment that it operates in today's time is a modern, very flexible, very fast changing environment, and it does not offer, if you look at our product, when we'll go down as well, and in the pre-scene before, we have mentioned that there are very many different kinds of ingredients, very many different kinds of products, meal boxes, variants that we offer. So functional structure might not be very, very relevant for Meals at Home as we move ahead, as we move on. So a very realistic question in your exam could be to move from a functional structure to, let's say, a matrix structure, to, let's say, your geographically based breaking down divisional structure, to your product based divisional structure. It can be a very realistic situation. They can say that, we are opening up a new base in Southeast Asia. We're now going to treat it as a divisional structure. There will be 2 divisions. One will be the Northlandia division. One will be our new Southeast Asian division. So keeping that in mind, our E1 syllabus becomes important here. So in the future, we could definitely be asked that we want to move to a divisional or a matrix structure. How will it work? So you must have knowledge about this, and this is directly from your E1 syllabus. So as you can see, at every stage, we take ideas from the pre-scene, try to make sense of it, try to think of questions that can come up, and we point them out for you. Let's make a quick overview here. So we have Ben, who looks at sales, distribution, and marketing. Ravi, who deals with IT. Henry deals with recipe development and is a qualified chef. Greta deals with procurement and production. And Jack deals with finance and HR. Now I made this snapshot to show to you that all of these are executive directors who take part in the day-to-day of the business. No information has been given to us about any non-executive directors. Now, even in our F1 syllabus, we have studied the topic of corporate governance. Corporate governance says that you must have equal number of executives and non-executives, but these rules are for a listed company. We are not a listed company. That is made very clear in our pre-scene. But the corporate governance guidelines are set to be good practice, best practice for a big growing business. So our company currently does not adhere to the corporate governance guidelines, but as we grow and expand into the future, this could be something that we look at, something that we appreciate. So just to point out and bring in the F1 topic of corporate governance, I've mentioned this for you. Next, we go on to another subsection in the pre-scene, which is information about the company's operations. So now we are coming to the operations of the company. Sales and sales channels. That's what we'll speak about first. Now, Meals at Home sells meal kits direct to customers throughout Newland. We know that. Through the company's subscription service. We also know this. So since we are expected to make a profit in this year, the next step could be to start selling our products in neighboring countries and continuing to expand our presence. That's what big multinational companies do, right? Once they have a good presence in their home market, they try to start to expand. They try to start by looking at neighboring countries. So just an idea. The company supplies two sizes of meal kits. A small meal kit, which contains enough ingredients to prepare 2 portions of one meal, which means for lunch you can create 2 portions, or for dinner you can create 2 portions for 2 people. A large meal kit contains enough ingredients to prepare 4 portions. So it's a family of 4. Then it's a good option to have a large meal kit. Orders must be for 2 meal kits, 3 meal kits, or 4 meal kits. You can't order one. The company does not sell individual meal kits. Okay. Irrespective of the number of meal kits ordered, they will all be delivered in one box only. If you order 4, it comes in one box. This is because of sustainability, first. Second, reduces your packaging costs as well, right? There are therefore 6 box options available to our customers. How? For small meal kits, you have 2 meal kit options, 3 meal kit options, 4 meal kit options. For large meal kits, again, 2, 3 and 4. And the clear state has been given to you over here. They've mentioned the selling prices to us. Number of portions have been mentioned. Average price per portion, as you can see, is reducing with the larger with the larger quantity you order. So obviously you're giving customers incentive to order more. Same way for the large meal kits, your average price per portion is reducing. Again, you're making an incentive so that they order 4 large meal kits together, for example. Now this is the full retail selling price for each type of box as advertised on the company website before any promotional discounts. Now note this clearly. So this is your retail selling price. So all your budgets, all your forecast will be based on this selling price. Now if for any reason there is a promotional offer and you sell at a discount, your selling price will be different. So obviously there is going to be a variance in your budget. This variance is your sales price variance, and your sales variances topic from P1 becomes very, very important over here. Please make a note of it. So as you can see, at every stage in the pre-scene, they're giving you ideas, but you should know how to point them out. And that is why an important or a quality pre-scene analysis like we do is important. So what do we learn from these tables above? We have 2 main options to choose from. It's just a quick snapshot of the table. Small kits, large kits. Under each category, there are 3 combinations: 2 boxes, 3 boxes, and 4 boxes. As you can see, the price per portion reduces as the larger of the box options is purchased to make it an incentive. This is to make this option more lucrative, obviously. Selling a higher quantity to the same customer reduces your logistical charges, reorder charges, packing charges, making it more profitable to the company, and hence you are also making it a little bit more beneficial for the customer, so he goes for the larger option. This shows that we must try to promote our larger meal sizes. Promotions on the same can be looked at. So at every stage, carefully going through the pre-scene. Up until now, we've covered some very important aspects. So I would request you to stop. Make sure you are comfortable with everything that we have done up until now. Part 1 and whatever we have covered of part 2. Make sure everything is sunk in and then continue. The company is constantly developing new recipes and improving existing recipes for its meal kit. So we are constantly on the lookout for development. So innovation and development, as we know from the very beginning, is one of our core values. We have to stay true to the same. There are currently over 300 recipes in our portfolio. The recipes that are available are rotated and changed every 2 weeks, with 50 different recipes available for order each week. So we'll keep mixing, keep matching, keep your favorite ones on the top, keep the most selling ones on the top, and then keep changing the others. So there's a variety for the customers. So a large variety of options are available for the customer to choose from. Since we offer these different options, costing for each option, then pricing for each option has to be a very robust system in place. And we are going to speak about costing in a later section, but pointing out to you that costing in this business will be very, very important. Otherwise, how do you predict your margins? How do you make a profit? Next, the portfolio of recipes includes a range of meat, fish, and vegetarian dishes. There are currently no vegan recipes available. Now, my question is why? The vegan diet is one that is, people are more and more accepting, people are more and more converting, changing. So there is a market for this niche. This seems like an opportunity to grow. Lots of customers are now becoming health conscious or moving towards a vegan diet. We need to have this opportunity available. So since we already have a very highly qualified chef, why don't we start to look at vegan options as well? That is something that you can offer. And in a highly developed country, there will be people who know the benefits of being vegan or who may choose to be vegan, and catering to them could be a good opportunity for growth. So something for us to keep in mind. The portfolio includes seasonal recipes which utilize ingredients appropriate for that season only and which are more suited for certain times of the year. For example, casseroles and stews for cold weather and salads for warmer weather. Okay, but this tells me that at different times of the year, in different seasons, I will have to predict, I will have to buy different kinds of stuff. So seasonal variations and focusing your attention on key business periods is vital for my business. So your time series analysis, seasonal analysis becomes a very important concept, and it is a favorite exam question as well. Time series often does come up, so you must know what a time series analysis is, how can it be useful, what each part of the time series formula means, what the seasonal variation means. There will be no calculations for you. A table will be provided to you in the exam, and your job will be to explain the trend line, explain the seasonal variation. So the topic must be clear to you, and this is from your P1 syllabus directly. Now they have explained us the standard booking procedure, which means how can you book your meal kits. Customer needs to be members of the subscription service before they can order a box of meals. So they have to become a member of the subscription service. The features of a subscription service already explained to you at the very beginning. Membership is free, and when the subscription is set up, a customer selects whether they would like to receive a box of meal kits once a week, once every 2 weeks, or once a month. Customers also select whether to have small or large meal kits and whether to include 2, 3, or 4 meal kits in each box. They also select any dietary preferences that they may have. Any of these initial preferences can be changed at any time. When a customer orders their meal kits, they can override these preferences as well. For example, if at one point they want a large box rather than a small box, they can do that. So flexibility is being given. Remember, this is just the standard booking procedure that is being explained to help you get in touch with what the company's procedure is. They also select any dietary preferences. Any of these initial preferences can be changed at any time again. The customer is required to make their meal kit selections at least 3 days before the box is due to be delivered. This can be done on the company website or via the Meals at Home app. Clearly tells us now a very important revelation here that there are two digital products that we have: the website and the application, the mobile app. The customer has the right to pause their subscription at any time without penalty. Now, app management, website management will be a key skill for our business. If your website is not good, fast, clear, if your app is not good, fast and clear, nobody's going to be interested to order your meal kits. No matter how good the actual meal kit is, the interface has to be easy. Big data opportunities, again, that we've spoken about before are further evidenced here because you'll be gathering all of this customer data. This brings in the digital aspect from your E1 syllabus. However, if the customer forgets to pause or to select their meal kit preferences, they will receive a box based on their saved preferences or past meal kit selections, and they'll be charged for it because it is their duty to cancel it or pause it if they don't want the box. The company offers promotional discounts throughout the year to attract new subscribers. So promotional discounts keep running. A typical promotional discount will be 50% off the first box and 30% off each of the next 2 boxes. So for the first 3 boxes, you have lucrative offers, and innovative marketing programs will be important for your business to reach a certain level of, customers or subscriptions. This brings in again your E1 syllabus. Let's speak about our production process now. So we did the booking process, how you can book our subscription service. Then we did our sales and distribution we spoke about. Now we are speaking about the production process. How is the meal kit actually produced? So it's important again to know this because sometimes, they'll make very clear references saying that the machinery involved in herbs and spices packet production has spoiled. If you don't know what the machinery does while in this production process, how will you make sense of it? And if you don't make sense of it, how will you register it and then present an answer? You won't be able to do that. So the pre-scene is the backbone of mock question writing and writing answers in the exam as well. So every process of your company, every step of your company has to be understood. Don't learn anything, but go through it multiple times so the ambiguity is removed. Let's start. There are 3 main production processes. The first one is herbs and spices packets production. So over here, your dried herbs and spices are purchased in bulk. Some meal kits require herbs and spices to be portioned individually. Others require a mix to be created. Via machinery, the appropriate herbs and spices for each meal kit are portioned. So the machine does the portioning. The meal kit portions are sealed into packets of biodegradable material. So it's not plastic which is thrown away and harms the environment. It's biodegradable. So what we learn from this, after every process, we'll have a box to analyze. The portioning is done via machine. This is good as it saves time and is more effective, yes. Some businesses do it manually, but accepting modern techniques is key for more efficient production. How you can use these machines further, more modern manufacturing, more automation, something that most businesses are looking at. So are we looking at bringing in more sorting machines or more, packaging machines as we continue to grow? This also brings in the need for capital requirement. As you grow, one machine may not be able to do, meet the demand. So will we need more machines? If you do need more machines, it brings the question of capital requirement. Capital requirement again is part of your F1 syllabus. So your topics of working capital management again come into the picture, because if you don't have a good working capital cycle, if you don't have enough cash, if you don't have enough money, how are you going to purchase the machine? So this is one way to look at it. And the IAS 16 property, plant and equipment also needs to be managed here. Your topic of leasing can also be incorporated here, because you can lease the machine as well. So there are very many options when it comes to, buying a machine, or how do we record the machine, or how can a lease be taken. So 3 ideas given to you here. They mentioned that a spice mix is often created. This brings in the topic of your mix and quantity variances, straight from your P1 syllabus again. Next process is meal kit bag production. Now a meal kit bag contains all of the long life ingredients for either a small or a large meal kit. This includes any dried herbs and spices packets that are required. Once the packet is made, then the bag is made. Meal kit bags are assembled on an automated production line that operates 20 hours a day, 7 days a week. So it's almost continuous. The 4 hours is closed probably for maintenance. The production line can deal with multiple meal kits at the same time. Meal kit bags are usually produced the week before the meal kits are due for dispatch. If you have to give it on next Monday, they're produced on this Monday, for example. Now this clearly tells me that a single production line looks like a bottleneck procedure here. If you want to increase your output, you may not be able to do it because you have a single production line. It operates 20 hours a day and all 7 days. So right now you can say that it's pretty much on full capacity. Any breakdown or delay here is going to cause big repercussions for the business. So the concept of maximizing throughput could be considered here, because if there is a bottleneck, how do you make sure you are efficiently reaching the maximum possible contribution for each product? So maximizing throughput is a concept that comes, bottleneck management is a concept that comes into the picture here. Now kit bags are produced 1 week in advance, meaning we hold them in inventory for 1 week. The customer needs to place an order minimum 3 days in advance, meaning if we have already stocked up and we do not receive orders of some perishable kits, then they would be rendered useless, already packed but not going to be used. So something to keep in mind as we keep the business, as the business moves forward. Mainly, I want you to take into account over here one line that is almost working at full capacity. So capacity planning and bottleneck planning is something that we must keep in mind in your P1 syllabus again. Now we have the box packing process. That's the third production process. The boxes of meal kits starts to be assembled and packed 4 hours before dispatch only. The packaging of ingredients into the box is a largely manual process which is carried out on a production line that runs through the facility. The box packing process is detailed below. So it's going to come up. They're giving us more details on the box packing process. But what we see over here is that it is a hand assembly process, which means it's going to be labor intensive. So are we looking to increase or invest in packaging machinery so that we can use this for assembling more meals? Could be faster, could be more effective, efficient in the longer run. So again, your capital requirements, IAS 16 on how you will record a new asset if you purchase it, come into the picture. Now there is a box packing process that they've explained. Just the steps, I will lay them out for you in a simple way. So step 1, at the start of the production line, the system generates a label which contains a unique barcode, which when scanned gives the size of the meal kit selected by the customer and their order. So a label comes out on which a barcode is printed, which gives full details about that customer's order. That's step 1. Step 2, based on the label, the correct sized outer box is selected by a robot. So in this process, there is a robot and formed. An inner chill box is also placed into the outer box by the robot. So there's a big box. Under that big box, there's a chill box under which your perishable ingredients will go. Both the outer box and the inner chill box are made from recycled cardboard. The label for the box is stuck on the top of the outer box. On the outer big box, the label will come on the top. Step 3, the box moves along the production line to the meal kit bag area, where the appropriate meal kit bags based on the unique barcode are picked and placed into the bottom of the box by robots. Recipe cards are also added at this stage. So see how all the processes are coming together in your last process, which is the box packing process. Step number 4, the box moves along the production line to the fresh ingredients area. The packer scans the unique barcode on a handheld tablet, which gives them the list of the fresh ingredients that are required. The fresh ingredients are then picked and packed into the box on top of the meal kit bags. So as you can see, some processes are automated, some processes are labor intensive. So again, are we trying to make everything automated? Question that comes up. Most fresh fruit and vegetables are packed loose. Care is taken by the packer to reduce the risk of ingredients being damaged in transit, because quality is something that we want to maintain. Step number 5 is the box moves along the production line into the chilled area of the production facility. So fresh ingredients came, then the chilled area is coming. The packer in the area again scans the unique barcode and knows which chilled ingredients to put in. Step number 6, the box moves to the final section of the production line. There is a check to ensure that all the ingredients are packed and it's well put. So a frozen eco chill bag is placed onto the chilled items to keep them cool in transit. The inner chill box lid is closed and the box is passed through machinery which closes and seals the outer box as well. So the inner box closed and then the outer box closed. The boxes are transferred to the dispatch area via a conveyor belt. So there are 6 steps in the entire making of a meal kit box that is ready to be delivered. Carefully go through the 3 production processes and then these 6 steps in the last production process, making your goods ready to be dispatched. Now, my question is, if we identify more than one constraint, I'm sure in all of these processes, there will be more than one constraint. And if we want to find an optimal production plan, the use of LPP, your linear programming problems, how do you solve linear programming problems? How do you solve constraint problems when there is more than one constraint? If there is only one bottleneck, you can use the your throughput accounting method where each the product with the higher contribution is maximized. But if there is more than one constraint, that is where LPP comes into the picture, brings in your P1 syllabus. Linear programming graphs are often tested in the exam. They'll give you the graph and they'll give you the feasible area. They'll give you the equation. They'll ask you to then explain. No calculations, but explanations are often warranted, are often recommended. So study the syllabus areas that we are pointing out to you very, very clearly. To recap, there are 3 production processes and 6 steps. We must know them clearly. Next, we are talking about the packaging section now. Packaging, as we all know, is a significant component of a box of meal kits. All packaging is purchased from a single supplier only. So the question that I asked you before, on thinking of the benefits and limitations of a single supplier, thinking of the benefits and limitations of a multiple supplier agreement, come into the picture again. This is straight out of your E1 syllabus. The main elements of packaging purchased by Meals at Home are the strong outer box, which is made from 100% recycled material, inner chill box, which is made from layers of corrugated cardboard, which acts as an insulation. This is also 100% recycled cardboard. The eco chill bag, which goes on the chilled ingredients, which has an inner gel core which can be frozen. The bag can be refrozen and reused by the customer as well. Meal kit bags, which are made from 100% recycled paper. So from this we know that the company is being very sustainable in its approach. At every step, your social responsibility and sustainability is at the center of decision making. The costs and benefits of maintaining high business standards along with costs of quality need to be kept in mind. Your environmental costs need to be kept in mind, which are in line with the costs of quality. If you don't invest in prevention costs like we are doing, if you don't invest in appraisal costs like we are doing, then your internal failure costs, external failure costs can become very, very high. So the costs of quality from your E1 syllabus become important here. Next, the packaging supplier's production facilities 5 kilometers from Meals at Home only. Since 2013, Meals at Home has worked closely with this supplier to develop new ideas of packaging, including our recently launched inner chill box. Reducing the carbon footprint associated with packaging used in boxes of meal kits is our priority. There have already been significant improvements in sustainability since the company started trading. Now there are some key words to learn here about our company's core, which we always must stay true to. Premium quality always. Price could be higher than competitors to showcase our innovativeness, our recipe development, our recipe options, and high quality ingredients. We are innovative to the core, strong supplier relationships, and lots of focus on packaging, which is quality and sustainability. Now, these are some very important key words or core areas you must stay true to, you must always remember and try to use in your answers, because these are your core competencies for your business. So what has been done since the business started in terms of packaging? Ensuring that everything is 100% recycled. Removing the packaging for most fruits and vegetables. These are now packed loose, so you're not using that extra cardboard. Working with suppliers to reduce your non-compostable plastic. Using packets made from biodegradable material. And introducing an inner chill box and multiple use eco chill bag to replace your single use plastic chill bags. So you incurred that extra expense to make sure your sustainability credentials are good, plus you gave something extra to the customer because the customer will be able to reuse this. So these are our core principles. Make sure you remember them. Next, we are speaking about distribution. Packaging done, come to distribution. Now, distribution of boxes of meal kits to customers is outsourced to a major distribution company, which delivers anywhere within Newland 7 days a week. So they are good, they have a good reputation in the market. This part has been outsourced, fine. This is not my core competency, right? I'm not a delivery company. I am a company that makes meal kits which customers enjoy. So I can outsource non-value adding activities like we have done right now. The distributor uses a fleet of registered refrigerated vehicles. Currently 75% of this fleet is powered by diesel and 25% by electricity or biogas, which means the person that we are dealing with, the distributor, is also slowly becoming environmentally conscious. The distributor aims for 90% of its fleet to be powered by electricity or biogas within 5 years. So remaining again true, you are associated with a company that is also moving in the sustainability direction. Good thing. Next section, we are speaking about the employees of our company. So Meals at Home had the following number of employees on the end of 31st December 2021. If you see, the production facility employs 445 people. Head office employs 62 people. So a total of 507. Okay, looks like general information. But when we want to analyze it, we will see that 62 people are involved in the head office, right? So 62 people to manage most important functions of the organization raises a question for me. So the breakup of the head office function is not given here. They've not told us how many employees in each department. None of that is known. So we assume that IT, HR, finance, accounting, marketing, sales, everything falls under head office. We'll assume that. So everything except for the production aspect falls into head office. So again, a question coming up in my mind rather. So IT is ever growing in this digital world with app management, website management, in line with the development of our organization. Further IT improvements will definitely be on the cards. Same way, innovative marketing techniques are really important for my business. If staff are under unrealistic pressure, then they will not be able to perform and meet the goals that our company aims to achieve. Also, the HR function over here, no details. So HR is one of the most important functions in an organization. People make companies, and having the right people, competent people, is imperative. The finance function also is ever evolving. Digital finance, a lot of financial requirements are evolving. So if unrealistic workloads are being implemented on our organization, on the people of our organization, it will not be to the long-term success of the company. So are 62 people enough to manage all of these head office functions? That comes to my mind, and this brings in the topic of new employees coming in, your HR cycle being tested, your team management, your resistance, your conflict management, E1 syllabus becomes important here. Next, a very important section, the standard costing and budgets section. Very important information coming your way, pay attention. So the company operates a standard absorption costing system using departmental overhead absorption rates based on either direct labor hours or machine hours. So very, very standard absorption system being used. For a big company like ours, which is progressive in its thinking, forward looking in its thinking, and produces different kinds of products, different meal kits with different variants, different sizes, different ingredients, a robust costing system is very important. We spoke about this before. A standard and traditional absorption costing has its flaws. This is where your P1 syllabus comes into the play. A very, very exam favorite question is activity based costing. They can give you a table of your standard costing right now. Then they'll give you a table that they'll create of activity based costing, and they'll tell you why are the costs per product different. Why is activity based costing different? So you should know the principles of activity based costing, how it works, what are cost pools, what are cost drivers. You must know the advantages and disadvantages of using activity based costing, advantages and disadvantages of using your current traditional absorption costing system, because these are exam favorite topics which will often come up. So very important to note this. Moving on, the standard cost of the ingredients for each meal kit is established when the recipe for the meal kit is developed and updated for known price changes twice a year. So use of a standard cost card is mentioned here, and it only changes twice a year. So this is how a standard cost card works. Standards for all other direct inputs, which is your packaging, your labor, are established per box of meal kits, and this is also updated twice a year for known price changes, significant price changes. So a standard cost card follows the standard costing system. So again, when you go through the advantages and disadvantages of the same, you should know why this system will not be effective for us, or why this system could prove to be non-beneficial for us from the costing system. We'll speak about the cost card as we move deeper into the pre-scene because they've given us a cost card. But right now, this is the analysis that we are making and straight out of your P1 syllabus. Another P1 aspect is budgets. So they're telling us the budgeting process is centrally managed by the finance department with limited involvement of middle or lower level management. Everything centrally managed at the top. So this paragraph mentions the use of a top-down approach where budgets are set by the top management and the lower level managers will simply follow. This will not seem to be very beneficial in the modern business environment, dynamic business environment. On the other hand, there is a bottom-down approach where budgets are set by bottom-level managers and then agreed to by the top-level management. Both methods have their advantage and disadvantage. Right now, we have the top-down approach. Try to think about a couple advantages, couple disadvantages of top-down approach, couple advantages, couple disadvantages of the bottom-down approach. This is part of your P1 syllabus. This is very important information that we're giving you here. Next, we speak about the meal kit industry. Now, as part of this entire pre-scene analysis, they've given us a small snapshot of the industry analysis over here. But guess what? At the very beginning, you did an extra industry analysis with me. You've already done it. So you're ready. You will already know most of this information, but it will be some new extra information that they specifically want to give you. Let's go through it as always. So the first company to sell a complete meal kit, Hooper's Delight, did so in the United States of America in 2008. This is information they are giving us. We will let it sink in. Sales of meal kits were initially slow to begin with, but in 2012, there was significant growth throughout the world. We already know this is a very big market with new opportunities every day. Market picked up pace in 2012. So it's been 10 years since it's roughly been well established. From 2012 to 2021-22, 10 years. It's still quite prominent in developed Western nations. Now, expansion into developing nations could be seen as the next step here. Developing nations. From our industry analysis, we already know it's the Asia Pacific region. Meal kits avoid the need to shop for groceries and limit the amount of food waste at home. This can be seen as two of your major marketing factors. Avoiding buying grocery, saving time, and limiting food waste. This can be at the center of your marketing campaigns. As such, early meal kit companies targeted young professionals rather than families. Over the years, this has changed, and now families are also one of the very large parts of this market. So this can be seen as an opportunity for us to focus upon, again, family market. Families will obviously purchase, larger size boxes in more quantities. So it could be the area to look at. Busy family life and desire to eat quick but home prepared food rather than takeaways or unhealthy convenience food has driven this increase. The whole idea is three things: not to buy grocery, saving time, and limiting food waste. Now specifically, meal kit industry in Newland is being spoken about. Now within Newland, there are currently 6 large companies that sell meal kits, large companies. Each of these 6 companies generate revenues from the sale of meal kits of more than 50 million dollars. So we will say it's the situation of a brand competition. Now brand competition means it can be defined as rivalry between the companies offering similar products, similar market, similar audience with the goal of having a higher market share. All these 6 companies are serving the same market, same people, same products are also being given. The only difference is their brand. So it's called a situation. This situation rather is called brand competition. So there will be intense competition in this market. 6 big players serving one market. 2 of these, which is Hooper's Delight and 5 Meals, are multinational companies with worldwide sales. So they'll obviously have bigger goodwill. They'll obviously have a brand name. The other four, which is GDQ meal kits, meals at home, your company, Go Food, and Prestige Kits, operate and sell meal kits only in Newland. Again, a clear opportunity for us to expand. Maybe this market is reaching its saturation. You need to look at newer, greener pastures for your company. There is good competition in this market. So let's become, first mover in another market. Let's look at expansion. So this is competition information that is being given to you over here. There are also several smaller companies that sell meal kits and either operate regionally or offer different kinds of services. For example, party catering, different international cuisines. They don't become your direct competitors, but yes, they are set to be part of your industry. Very interesting pie chart given to us now. For the year ended, the total revenue from meal kit sales in Newland was split as follows. Let's look at the most interesting thing, which is meals at home holds a 11% market. Hooper's Delight can be said to be the market leader, 26%. So I want you to remember a couple of these competitor names. Again, can be useful when you're writing a mock answer. Let's say you're writing anything on marketing, revenue growth. You can say that, having this innovative marketing program will help us close our gap to Hooper's Delight because they're currently the market leader. Shows the examiner that you have gone through the pre-scene. Your integration marks will come into the picture. Make sure everything that I'm reading is for a reason. So you let it sink in and it will only automatically come to you if you've gone through this material 15 times, 20 times before the date of the exam. So Hooper's Delight is your market leader. As of now, we capture 11% of the market share, growing our share, seeing how we can expand our business through new products or new geographical areas where we sell has to be a decision the board makes. All 6 of the large companies have seen significant growth in revenue over the past 5 years, averaging 7% per year. So the growth is, I will say, not bad, but good, but okay, rather okay. Not good as well, okay. So evidence of a growing market and hence lots of new opportunities, but being on the lookout with good external market analysis, always looking out for opportunities has to be the way forward for any business. Each of these companies has its own unique selling point. For example, Meals at Home focuses on nutritional healthy meals. Others focus on vegetarian meals, vegan meals, organic ingredients. Obviously, everybody will compete on different characteristics. To be the market leader, you must be the best in all products in your particular business. So expansion can be seen for the way forward. We don't have vegan meals right now. We don't have, we have vegetarian meals, but furthering our product catalog, making sure we serve everybody in that market. Whenever anybody wants a meal kit, Meals at Home has to be on the top. That should be the thought process here. The rate of growth in the market has now started to decline. Important information. And therefore, many of the companies have started to extend their product ranges. For example, GDQ Meal Kits has launched a range of frozen, ready meals. Prestige Kits, a range of healthy smoothies, soups, and protein bars. They're doing something different because, so this is called product development because there is a decline in the market. So obviously your company Meals at Home has to do something, come up with a new product or sell your products in various markets. So I'm seeing a very straightforward suggestion to expanding in different geographic areas. Because there are certain challenges that face this meal kit industry, it's growing downwards. We spoke about this in our industry analysis as well. The first being price competition, reduction in customer loyalty has so many options, pressure to reduce the amount of packaging, and sustainable sourcing of ingredients and packaging is becoming expensive. So the margins are reducing. Profitability is going down. So these are the challenges that the meal kit industry is facing, and that is why it's now on the decline. So what we did over here was an industry analysis that they gave us with competitor information and some very important outlooks. We went through it in detail. We are now on to a very important section, the financial analysis section. This is when we start to analyze the financials of the business. We start to look at the numbers. We start to look at, the main backbone of the business, which is the financials, the money. We are going to carefully analyze each part. We're going to carefully make sure each ratio, each number is understood, because to understand the full strength of the company, the financials are an important aspect. So our financial analysis is very unique. It's very detailed. Let's begin. So first thing, we will look at the actual numbers that CIMA has given us, the actual statements that CIMA have given us. Then we will make an analysis on the same. So first, looking at the absolute numbers. So the statement of profit or loss comes in front of us. We look at the revenue. Revenue has gone up by a good margin. Cost of sales has also gone up. Okay, if revenue goes up, obviously you made more products, so more cost was incurred as well. You made a healthy gross profit of 28,750. Coming up, your selling and distribution expenses went up by a little. Admin expenses also went up by a little. Your operating loss for 2021 was almost half of your loss of 2020, which means the business is moving in the right direction. The business is making sure that it's taking the right steps. So now finally your revenue has reached a level where it's moving towards a profit. So your margins are now being controlled and you are now prominent in the market. That is why your revenue has started to increase. And then there is a waterfall effect, which you can see your operating loss rather has almost halved than the last year. Your finance costs went down. Loss before tax, again, it is almost halved from the previous year. And then the loss for the year is the same figure. Looking at these numbers, in 2021, the business seems to have had a strong performance. Now, I want to showcase to you my analysis of the same. Now, we create a very simple, easy to remember analysis for our students. If I tell you before I go into any more details, let me tell you why these financials are important. The first reason these financials are important is to understand our company that we are doing. The second reason, the hidden reason behind this, is to use these numbers when we go to mock writing, when we present answers in the final exam, to take your integration skills to a completely different level. Why? Because let's say you're writing anything, any answer. You start your answer or end your answer by saying that our revenue has increased by 24%, shows a healthy sign and shows a move towards profit. And then you continue writing whatever you have to write, answer whatever they have asked you. But just by including that percentage, just by including some details from the financials, the examiner knows that this student has spent the time on this material. This student has understood the underlying strengths and weaknesses of this company, and it takes your integration marks to a completely different level. So two reasons: one, to understand the company; second, to let you digest these numbers and then use them when the time comes when we go to mock writing. Now, obviously, we don't expect you to remember everything, know everything, learn everything. But we want you to go through this multiple times, so some of these numbers will fit with you. Now, what happens is, if you look at the absolute numbers on the previous page, it's very difficult for any student to remember 62,500 was my revenue. Cost of sales was 33,750 or gross profit was 28,750. It will be very difficult for any student to remember that. right? So what we try to do is we give you percentage forms. Easily remember. Increase in revenue, 24%. Increase in cost of sales, 20%. So your revenue went up by a larger margin than the cost of sales. Good thing. Increase in selling distribution costs, 14%. Admin costs, 3.6. Decrease in operating loss, 52%. Your decrease in finance costs came up to close to 26%. And your loss before tax became 50.53%. Now, if I look at these numbers, you'll see some of them are highlighted in red. These are some important numbers which you can try to remember, try to gather, and then use when the time is right. For example, our revenue has increased by 24%. When you start your answer in that way, it adds a whole lot of value. And we don't want you to learn anything. Go through this 15 times, 20 times, and automatically, at least out of these 4, 2 or 3 numbers will remain with you and you will be able to use it at the right time. But for that, you will have to spend time with the material. Now, obviously, your tax expense is going to be 0 because tax is only paid on profit. Here there is a loss, so there can be no tax. Just to be clear, these numbers are for you to, go through multiple times so you can pick up on them when the time comes. And after every single analysis, we have given you a conclusion of the same, which means a further, just what I spoke, the explanation that I just gave is put into words for you over here. So our operating losses were cut down by more than 52%, which shows improvement in profitability. It is important to note that the finance costs also went down. Only 2 reasons there can be for finance cost decreasing. You paid off some part of the debt. That's why you don't have to pay the interest. Or second, your interest rates went down drastically. Next, though we are making losses, we showed sign of improvement. Effective tax is 0 because we are still incurring losses. Operating profit margin and net profit margin increased. So again, company is moving in the right direction. What we want to do is making sure that you understand the underlying theme here. Revenue increased, your cost of sales increased but by a lower percentage. So the company is moving in the right direction, and that was clearly visible, clearly mentioned throughout the entire pre-scene analysis as well. But these numbers will sink in for you. We have already done all the calculations. Everything is already done and put for you in a very well systematic way so that you don't make an error and everything is ready for you. You just have to go through it, go through my explanation first, then go through it by yourself. I'm sure you'll start making sense of the numbers. Second table, we are now looking at absolute numbers, statement of financial position, or the balance sheet, if you want to call it that way. We'll quickly go through the items, then we'll go through my analysis. So for the non-current assets, you have property, plant, and equipment, which you can see from the last year. On the right-hand side are the last year figures, left-hand side are this year figures. Let me just put it into perspective better so we understand it. So if you see, 2020 is on the right hand side, 2021 is on the left hand side. Property, plant and equipment has reduced, which means you sold part of your property, plant and equipment. Intangible assets have gone up, maybe a new patent registered, we don't know, but yeah, you can make assumptions. For the current assets, your inventory has gone up. Your receivables slightly gone down, and cash and cash equivalents are 329,000. Looking at the 3 zeros above, let's just look at absolute numbers. Cash and cash equivalents are 329. Nothing too alarming, very, very straightforward. Let's look at the equities section now. Now your share capital was 500 in the last year. This year it's become 600. So new shares or new ownership was taken up, and obviously share premium also went up because of this. Retained earnings have gone up and your total equity is shown. Non-current liabilities, borrowings remained the same, 5,600, 5,600. Let me make a very clear analysis over here. You saw before that the finance costs had gone down. There were two reasons for it. Borrowing paid off or interest rates went down. Over here, no borrowings have been paid off. They've remained the same. This is the table that CIMA has given. It's quite alarming, quite surprising. But okay, with the information that they've given, we assume that the interest rate must have dropped. Current liabilities, the overdraft went away. There's no overdraft. Trade and other payables went up, and that gives you your total equity and liabilities amount. Let's now look at an analysis that we created for you. So looking at the analysis for you, presenting it side by side so it's easier for you now. Statement of financial position analysis on your screen. A very important aspect that we calculated is your ROCE. The formula is generally operating profit upon capital employed, but we don't have a profit. We don't have an operating profit. So your ROCE last year was minus 3.23 because you're making a loss. This year it almost halved again. Shows that the business is moving towards profitability. This year, 2022, you are expected to make a profit. Good sign for the business, right? Your non-current asset turnover, you can see increased, which can be attributed to the increase in sales. So this is something that, is a good sign. You're generating more revenue with the same amount of non-current assets. So good thing. Current ratio has gone up slightly. Quick ratio pretty much remained the same. So current ratio and quick ratio measure the liquidity of your company. A ratio of close to 1 would indicate that the company has enough short-term funds to meet its short-term liabilities. Since the ratio is much less than 1, both of them, current ratio is generally 2:1. Current assets should be 2, current liabilities should be 1. Quick ratio is 1:1, but still both of them are much less than 1. It indicates that there is a very high chance that the company may face liquidity issues in the near future. Liquidity issues relates clearly to your F1 syllabus, F1 topics, which has a high possibility chance to come up. Your return on assets obviously will be negative because there is no net profit. An important number is the gearing ratio from 2.33 coming down to 1.69 because more equity was issued. Debt has remained the same. More equity was issued. We saw that in the balance sheet. So your gearing ratio gives an understanding of the financial leverage of the company. A ratio exceeding 1 generally would indicate that the debt that is present in the company is at a higher side. Now debt is cheaper than equity. Surely, yes, we know that because your interest payments on the debt are tax deductible. Before you come to your profit before tax, you are going to remove the interest payments and then your tax is calculated. So it's called debt. So debt is tax deductible. That's a characteristic of debt, and that is why businesses go for loans. We know that, but that is only to a certain extent. You can't keep taking on more and more outside money because at the end the interest payment will be quite large. That seems to be the issue with us over here. The gearing ratio has decreased, which is a good sign. Equity was raised, however it's still very high, still quite high. The company can be said highly geared, and a highly geared company is considered risky in financial terms. So as we move forward, we need to use equity finance as well to balance the debt aspect which is high in our balance sheet. Three important numbers rather I would take from this analysis: the ROCE, try to remember it, current ratio, and gearing. Interesting numbers to look at. Now I have given you my conclusion, I have given you my perspective. While going through this, if you come across something that you want to represent in another way, you make sense of it in another way, you can write to us and we'll take your point into account and tell you if you can follow that perspective. This is my suggestions out of the expertise that we are giving to you. So let it sink in. It's lots of numbers, I know that. Carefully go through it, invest time. It's all about the time that you invest. You go through it 2-3 times, I'm sure you'll start making sense of it. But slowly revisit my explanations. Pause this video, revisit my explanations if you want. Listen to them 2-3 times and then go through these numbers by yourself. It will add value to your study, surely. The third statement that they've given us is our cash flow statement. If you look at the cash flow statement, we'll first look at the absolute numbers on the left hand side, then look at the analysis on the right hand side for each part. Now the cash flow statement is divided into 3 parts. From our technical knowledge, we already know that: operating activities, investing activities, and financing activities. First, operating activities, the largest section we'll look at. Start with the loss before tax, 4096. Adjustments is your amortization of intangible assets. You add back because it's only a bookish entry. Amortization for intangible assets, we call it amortization and not depreciation. When the value of these intangible assets reduces, we call it amortization. So the amortization, just like depreciation, is added back because it's not a cash entry. It's only a book entry. Depreciation does not happen really. It happens in the books, right? Same, the loss on sale of property, plant and equipment, added back. Finance costs, added back. Then we come to the working capital category. Increase in inventory, subtracted. Decrease in other receivables, added. Increase in trade and other payables, added. This is true to the formula of making a cash flow statement. 355 is your total, and your cash generated from operations is a negative 1755. From this, tax is not paid, so no adjustment. Interest is paid, remove it, paid out. So your net cash outflow from operating activities comes to negative 2151. If I make an analysis of this, it's very straightforward. Sold part of the property, plant and equipment, which we saw in the balance sheet, but we sold it for a loss. In 2021, working capital decreased. Working capital generally is current assets minus current liabilities. Due to decrease in working capital, there has been a net cash inflow of 355, as you can see over here in the calculation of movements in working capital, positive 355. And that was telling me that a negative cash outflow from operations is seen over here, mainly because you started with a loss before tax. That's your first segment, operating activities dealt with. Next segment is investing activities. Purchase of intangible assets. You may have purchased an any kind of, for your business, it could be a patent, it could be a recipe that you are charged for. So purchase of intangible assets is negative 1205. You bought it, so money went out, cash minus. Purchase of property, plant and equipment, there was also a purchase of property, plant and equipment that was recorded here. And proceeds on disposal of property, plant and equipment. You purchased and you also sold. That is coming to light over here, which they have clearly mentioned for us. Let me scroll down to make it easier for you. This will tell us that the net cash outflow from investing activities came to negative 1280. We purchased intangible and tangible assets in the current year. It is also important to note that we sold a property worth 280,000 for 200,000, and that is why there was a loss of 80,000 which was showcased at the top. You'll see loss of sale of property, plant and equipment 80, proceeds on disposal is 200. So obviously if you made a loss, the actual listed price for your company in your balance sheet 280,000, and that is why you made a loss of 80,000. Just showing you the relevance and reliance of each of these numbers. Third segment is financing activities. Issue of share capital. You issued new shares. Very clearly we saw that in the balance sheet. So issue of share capital. That's the only item here which tells me that there has been an inflow of cash, or rather the largest inflow of cash due to the issue of shares. What we want to note over here is, because of this issue of share capital, the largest amount of money came in, and your net increase in cash and cash equivalents became 1569. Cash and cash equivalents at the start of the year was 1240. So at the end of the year, you have 329,000 in cash remaining with you. This is our cash flow analysis. So the majority of the cash inflow was because share capital was issued, somebody bought into the business because obviously they may have seen potential. So as you can see, a very detailed analysis. You'll have to spend time on it again to have a full understanding for yourself. As part of this financial analysis, we'll go through the budgetary analysis now. So budgets will be one by one looked at that they have given to us in the pre-scene. Again in details, again with our analysis, and again with the thought of you letting these numbers sink in and then using them to understand our company first and foremost. Second, to use it in your answers to better your integrative marks. Let's start. The first budget we're looking at is the total budgeted operating profit that they've given us. 3 columns here: small meal kits, large meal kits, and the total. Revenue is expected to be 3305 for the small kits, 4505 for the large kits. Now actually this is in millions because there are 3 zeros on top. So 30.305 million, 45.505 million. That should be the how we read it, but I'll stick to the absolute numbers to make it easy from an analysis perspective. But acknowledge that there are 3 zeros on top. It's actually 30 million and 45 million that we are speaking about. Then there is the cost of sales that is given. So ingredients and packaging amount, direct labor amount, variable production overhead, fixed production overhead has been given. If you see the production overhead totals, they are a significant amount when compared to the direct costs, which means direct ingredients, direct labor are the biggest, single largest costs for us. But variable and fixed production overheads are still a good amount. So to understand these amounts further, what forms part of variable production overhead? What forms part of fixed production overhead? A detailed analysis is required, which your current standard absorption costing does not give you. It groups everything and then uses an arbitrary overhead absorption rate to give you this number based on direct labor hours, direct machine hours. But not everything is influenced by direct labor hours, direct machine hours. Your inspection costs, your setup costs, all of this doesn't directly relate to labor hours or machine hours. So it's a very arbitrary distribution. So to understand my variable fixed production overheads better, a more robust costing system like ABC could be recommended. Then they give you your gross profit, your selling distribution expenses, admin expenses, and your operating profit of 2129 comes up. See how we did the analysis? You must also go through the same. I mean, go through the same at your own speed. Register what I mentioned so you can make sense of it. Analysis of the same, we expect about 40% of our revenue to come from boxes of small meal kits and 60% to come from large meal kits. This analysis tells us that out of these two products, large meal kits are being preferred. We expect our gross profit margin to be around 49% of the revenue, good amount. Ingredients and packaging would account for the majority of the total costs. Your ingredients and packaging comes up to roughly 60% of your total costs. So managing these costs is vital. We expect our selling cost to be above 21% of the revenue, which is slightly on the higher side. Can be said to be true because our company is still in its inception stage, heavily marketing, that's why making a loss up until now. Overall, we expect our operating margin would be around 2.8%. Total revenue that you generated, out of that only 2.8% is your profit margin. So you need to make sure your costs are well controlled. You understand your costs well. For that, like I suggested in the production process, ABC could be recommended. Secondly, you control your selling distribution costs, admin costs, something that you can control. So by looking at these numbers, you get a very realistic insight into the company's current scenario, current situation. That is why we went through it in so much detail. Analyzing the second table now, which is the budgeted sales table. Over here, we look at the small kit boxes and large kit boxes one by one. So for the small kit boxes, 2 meal kits, 3 meal kits and 4 meal kits. We know we supply in these three order categories only. Number of boxes sold 150,000 for 2 meal kits, 440,000 for 3 meal kits, 300,000 for 4 meal kits. So we expect to sell 890,000 small meal kits in total. Same way for boxes of large meal kits, we are also expecting to sell 890,000. Now this is the selling price after an allowance for expected promotional discounts. So they've reduced some amount. If you see at the beginning of our pre-scene, they had given us a table where they mentioned the selling prices before any discounts. From that, over here, they're saying that we'll give some promotional discounts and these are the final prices. So what we learn from this is the tables posted show the budgeted sales of our product range. We expect to sell equal number of small and large kits, but the proportion differs. For small meal kits, we expect to sell the most 3 meal kit packets, 440,000. For large meal kits, the most popular is going to be the 4 meal kits options, the 4 meal kits packet. Coming back, in the small meal kit range, we expect 3 meal kits to be the most sold product, accounting to about 49% of the total small meal kit. So it's the most favored product. Same way in the large meal kits, majority is your 4 meal kits section. Now this analysis tells us that this is the area where we can look to market, because this is what we are going to try to sell most. So it is most popular as well. So try to increase its popularity. Secondly, try to increase the popularity of the other factors that are not doing well. So try to increase the 2 meal kit sales, 4 meal kit sales for the small meal kit section. So this analysis shows that to us, that 3 meal kits most popular. For the large meal kits, 4 meal kits is the most popular. Average price per box of the small meal kit is expected to be $34 average. In the large meal kit, we expect to sell 4 meal kits as the most sold product, and the average price is coming to $51. Average price of box of large meal kit. Average, I'm saying $51.13. So we do this analysis, like I said, to help you understand which is the most popular product, which products we need to focus on in marketing, and which products we would want to increase the share of so that the company as a whole grows. Now to the fourth table, which is a budgeted gross profit table. In this, we'll first speak about the boxes of small meal kits, further breakdown, further details. Revenue given over here. What we'll see over here is the cost of sales for each type of meal kit is presented. I won't go into full details. I want to point out the important aspects here because too much numbers is getting confusing. I know that. Cost of sales they've given us for each item. Ingredients, direct labor, variable production, fixed production. We already know that. Gross profit calculated. Average gross profit per box is also given us, and that helps us derive the gross profit margin. Now to the analysis. If you look at the revenue breakdown, majority of your revenue comes from the 3 meal kits. We know that because that is the most that we are producing, most that we expect to sell. We saw from the last table analysis that we made. Most popular is 3 meal kits for the small meal kit package. So 3 meal kits generate 48% of the revenue, most important product. If I break down the cost of sales, I will see that the ingredients is the largest, single largest cost, 54%. Direct labor comes up to 30%. So majority of your input or your committed direct input is roughly 75% of your cost. Variable production overhead, 2.8%, which is still a large number when you take it together, is 400,000 in terms of costs. Fixed production overhead is 13.2%, close to 1.9 million. So these are huge numbers, and to understand this cost is key. If I break down the gross profit now, I will see that we expect 49% of the gross profit to come from 3 meal kits, followed by 4 meal kits, 34%, and 2 meal kits, 17% respectively. This is my gross profit breakdown, looking at the absolute numbers. If I look at the absolute numbers, I'm selling 3 meal kits at the highest number. It's the highest revenue. So it's going to generate a good profit margin for me. But if you see, the gross profit is 7832 for the 3 meal kits. Coming in second is the 4 meal kits, 5403. Coming in third is the 2 meal kits, 2639. Okay, but interestingly, the gross profit margin is highest for the 2 meal kits. So the product that I'm selling least, it's only 14% of my revenue, is the most profitable product for me. If it's the most profitable product for me, should I not be selling or attempting to sell this product to the best of its possibilities, capabilities? Because the gross profit margin is 61%. Then comes 3 meal kits and then comes 4 meal kits in terms of profitability. So this table gives me an analysis of my most profitable product being 2 meal kits, but still the maximum I sell, the most that I'm selling is the 3 meal kits under the small meal kit umbrella. You're only able to understand this because of this analysis that we are doing. So why is this analysis important? Again, 2 factors. First is you understood the most profitable product of your company in the small meal kits umbrella. Secondly, you can use this when you go to mock writing, when you go to answer writing. It can really add value to your answer. Just say that the gross profit margin, we should look to promote our 2 meal kits, our small pack of 2 meal kits, because it's going to generate the highest gross profit margin for us. Even if you don't remember the percentage, don't remember the number, it's fine. But if you make that analysis, the examiner knows this person has gone through the pre-scene. This person has the required knowledge. It adds integrative value. And you don't have to learn this. Trust me, go through it 15 times and automatically you will know most of these numbers. They will be fit in your mind. And when you use them, they will add great value to your answer writing process. Same way, fifth table we are looking at is boxes of large meal kits. Same analysis. Revenue given, cost of sales given, gross profit, average gross profit, and gross profit margin. If I look at the revenue breakdown, I know 4 meal kits is the most popular in the large package. So that's evidenced here with 57% of the revenue. Cost of sales is higher because obviously you need to put in more ingredients, more labor over here, justified. Cost of sales breakdown, if you do, again, ingredients and direct labor, largest cost. Variable and fixed production overhead still forms 13% of your cost. Interesting numbers again. If you see your gross profit breakdown, 54% of the gross profit will come from 4 meal kits, followed by 3 meal kits, followed by 2 meal kits. Most popular is 4 meal kits is going to generate, you're selling it at the highest possible quantity. It's going to generate good gross profits for you. But if I look at profitability, then the gross profit margin is largest again for 2 meal kits. So the product that I'm selling the most, which is my 4 meal kits, generates 44.3% of gross profit margin. But the most profitable or more profitable than it are the 3 meal kits and the 2 meal kits. So your further marketing processes should be focused on selling more of the 2 meal kits, more of the 3 meal kits, while you keep selling your 4 meal kits. I'm not saying stop selling it. No, that's not the right way for any business. Keep selling it, but now you've identified these are your profitable products. Also, focus on them, try to push them, try to generate a niche for them. There are some notes also that they've given for standards and budget preparation or the standard cost card presentation. First one is that standards are usually reviewed and updated twice a year. Now, why do we need to review standard costs? Because obviously material quantity may sometimes differ, material cost may sometimes differ, labor quantity differs, labor cost differs, and overhead costs may also differ. That is why you may have to constantly keep updating these cost cards. There is an added cost here as well because time is committed, labor is committed in updating these cost cards and then reviewing your pricing. So this is another drawback of the absorption costing system. Each meal kit has a separate standard cost per portion for the ingredients. This standard cost per portion includes a small allowance for wastage of ingredients. If there is wastage, your material quantity variance comes into the picture, P1 syllabus. All direct labor overtime premium is treated as variable production overhead. Idle time is not budgeted for, so idle time variance, labor variance coming into the picture. Production overheads are allocated and apportioned to cost centers and absorbed based on either direct labor hours or machine hours. So clear cut how much ever is the cost and how many ever direct labor hours it took. According to that, it will be apportioned. Very straightforward system. There are 3 production overhead cost centers: herbs and spices production, meal kit bag production, and box packaging. These are your 3 production processes. Each of these are cost centers, which means they will assign costs to them. Herbs and spices production, for example, 100,000 was your cost. Is it based on labor hours? Fine. How many labor hours did it take? 1,000. So 100,000 divided by 1,000 gives you your 100 as your cost per hour for herbs and spices production. This meal kit took 1 hour. Fine. 1 into 100, $100 assigned to this meal kit. For example, I'm saying. This is how your standard absorption costing system works. We already know it from our P1 syllabus. I just gave you an example of how it would happen in meals at homes situation. Each production cost center has its own variable and fixed production overhead absorption rates. How we calculate them, I just spoke about it. Budgeted selling prices include an allowance for expected promotional discounts. Sales variances topic again comes up into the picture. This is from your P1 syllabus straight away. With that, we come to the next section, which is the news analysis section. So there are two news analysis documents that are present in the pre-scene. We have already analyzed them. We have already put them in our own words, in our own way, in our simple, easy own way for you over here. First one is AI and robotics, how it's being used in the meal kit industry. We have put down our explanation in our own words for you to go through. Simply read through. No extra analysis required from your end. Simply read through. Second one is meals at home with Newland Packaging Award. Again, explain in our own words. Simply read through. No extra analysis from your end is needed. All the analysis is already done by us. So that is the news analysis section, which you have to go through simply by yourself in your own way. We have already done it for you. Just read through it, nothing else. And that will bring you to the last page of the pre-scene, which gives you the tax regime. It simply tells you what the tax rates are. Corporate income tax is 20%, fine. The expenses that are allowable for tax purposes, we already know that from our F1 study. So it's purely technical knowledge over here. Tax depreciation at a rate of 25% per year on reducing balance basis is available to you. Again, what does tax depreciation mean? Straight out of F1 syllabus. Now, your profits on gains, which means chargeable gains. If you sell an asset which you made a gain on, which is called long-term chargeable gains, in general terms is taxed at 20%. They're just giving you the numbers. If it is of any relevance, they will mention these percentages again in the question if it arises. So you don't have to learn anything from here. This is simply for you to go through. Sales tax is 15% and tax losses can be carried forward indefinitely to offset against future taxable profits from the same business. This becomes an important aspect for us because right now your business is making a loss. So for tax purposes, the loss can be carried forward against future taxable profits to reduce your tax liability. So it reduces the expense for your business and it can be carried forward indefinitely. It's not like this year's tax loss only can be, gained, only can be taken into account, can be carried forward indefinitely. So when you make a profit, these tax losses will be carried forward against this and your tax expense will be offset. This is the only important point that we will focus upon, that we will try to keep in mind. Everything else is purely simply information which you must keep with yourself, which you must go through. But this point that I have highlighted is the only one that you will keep in mind. To remove all, just apprehensions in your mind, know that we are talking about taxable profit here and taxable losses. We saw that taxable losses can be offset against any, gains that were past made. It's not operating losses. Our company right now has performed or showed up until now operating losses. If it was that way, then every company would show a loss when in the year they make a profit, the loss is carried forward, they minus it and don't pay any tax. That's not how it works. So to make it easy for you, this is the pro forma that is used, and if at the end you have a tax loss or a tax profit, is derived at the end of this calculation. You start with your accounting profit or accounting loss. You add or less all of these. And then if you have a taxable loss, it can be carried forward to adjust against any taxable profits. So remember, it's a quite intricate process. You don't need to know the details. I'm not asking you to learn this. I'm just explaining to you what it means so that there is no misconceptions, misapprehensions going on in our mind. So keep this with clarity in your mind. Don't get confused because they're saying taxable losses can be offset indefinitely. It's a taxable loss. There's a difference between an accounting loss and a taxable loss. Taxable loss will be calculated after all of this is done. You don't need to do it. You don't need to calculate it. I'm just showcasing it to you. After that entire journey, we have come to the end of the pre-scene analysis. So the pre-scene is a very, very long marathon, I would say. If you look at our pre-scene, it's about 68, 69 pages, and the video will come up to about 2.5 hours or so. Why are we giving you this detail? To help you understand our company to the very rock bottom. And once you have gone through this analysis at least 10 to 15 times till the date of your exam, every other day is what I would recommend. You have a solid understanding of your company, solid understanding of the material that they've given to us, which then gives us a great start to jump off and begin with mock question writing. Without good P1 knowledge, without good pre-scene knowledge, we cannot begin with mock questions. So make sure you concrete your knowledge on these and go through the pre-scene as many times as possible. Thank you. This is not a one-time thing. Please go through the pre-scene as many times as possible to let everything sink in. Thank you.